think about how you manage your cash. You are likely making a decision right now without realizing it, keeping your money instantly accessible at a physical bank or putting it somewhere it can actually grow. When you keep your emergency fund in a traditional account earning the national average of 0.01%, your cash is actively losing its purchasing power. Inflation eats away at the value of those dollars every single month. If you park $50,000 in one of these accounts, you will earn about $5 in interest over an entire year. You are paying thousands of dollars in lost potential just to have physical ATM convenience. The modern alternative is transferring your cash to an online-only high-yield savings account. Today, the top tier of these accounts offers rates upwards of 4.15%. You give up the physical branch and instant cash withdrawals. In exchange, you accept a minor layer of friction to turn a depreciating asset into a risk-free yield generator. The mechanics of compound interest drive this growth. It is the simple process of earning interest on your initial deposit, then leaving those earnings in the account to generate their own interest. Merchants and mathematicians have relied on these exact calculations to build wealth since the Renaissance. The modern accumulation function works the same way. You earn a percentage on your principal, and over time, you continuously earn interest on that newly accumulated interest. This split-screen chart compares the growth of $50,000 over 10 years. On the left, at the traditional bank average of 0.01%, the outcome is a nearly flat line, failing to generate capital. On the right side, at 4.15%, the curve bends upward exponentially, generating thousands of dollars in passive yield over that decade. The math clearly favors the high-yield route. However, the online banking landscape is highly fragmented. These institutions bury strict liquidity restrictions, balance minimums, and hidden rules in their fine print. Securing a return 400 times greater than your current bank means looking past the top-line rate and evaluating how the fine print fits your actual spending habits. We can sort the market into 3 categories, starting with the no-strings accounts. This chart maps interest rates against account friction. In the top left quadrant, high yield, low friction, we find banks like Forbright and Everbank. You can open these by depositing any amount of money, with 0 minimums and 0 monthly fees. You earn a highly competitive yield of around 3.85 to 4.15% on every dollar from day one. This makes them ideal for individuals with unpredictable cash flows. The required trade-off is the complete sacrifice of ATM access and debit cards. To use your money, you must initiate a transfer and wait 2 to 3 business days for the funds to reach your checking account. These no-strings accounts are designed for pure, unconditional compound growth, provided you never need your cash on a weekend's notice. The second category is threshold accounts, built specifically for maximizing returns on static emergency cash. Looking back at our chart, institutions like CIT Bank sit in the top right quadrant. The friction is high because you must agree to a strict minimum balance requirement, like keeping exactly $5,000 permanently locked in the account. Meeting this threshold qualifies you for a top-tier APY of 4.10%, maximizing your potential for compounding. But if an unexpected emergency forces your balance to dip to $4,999, the penalty kicks in. Your interest rate instantly plummets, cratering your growth. Threshold accounts treat a portion of your principal as a hostage. It is a highly lucrative arrangement, but financially punitive if your liquidity needs suddenly change. The final category covers behavioral accounts, which reward specific saving habits, like those offered at Happen Bank. To qualify here, you must commit to a recurring automated monthly deposit. You might be required to transfer $250 in every single month. Maintaining this schedule triggers a 4.00% yield, leveraging the math of recurring deposits to accelerate your savings timeline. The trade-off is strict rigidity. If you experience a tight month and pause the automated transfer, you lose your premium rate entirely for that cycle. Behavioral accounts act as excellent tools for forced savings, but they demand absolute cash flow consistency to maintain their value over time. With the fragmented landscape categorized, we can map these profiles directly to your actual financial behavior. This flowchart starts with one question: what is your primary cash behavior? If you are building gradually, you take the first path. You open a low-friction, no-minimum account like Forbright and route your paycheck there. If you are sitting on a lump sum, you take the second path as an optimizer. You audit your emergency fund to ensure it strictly stays above $5,000 and place it in a high threshold account like CIT. If you are cash reliant and might need your funds tomorrow, you take the third path. You split your finances by keeping 1 month of expenses in a traditional big bank and moving the rest into an online high-yield account. The trade-off for this split strategy is knowingly sacrificing the compound interest on that first month's worth of expenses. In return, you purchase absolute peace of mind and instant ATM convenience. The trade-off for the optimizer strategy is extracting the maximum risk-free yield possible while acknowledging that a specific portion of your emergency fund is now an untouchable buffer. And the trade-off for the beginner strategy is starting the compound interest clock immediately, but requiring the discipline to plan any major spending a few days in advance. The best account is simply the one where the specific friction points, like transfer delays or balance minimums, align with how you actually handle your cash.